Welcome again to another training by Larry Bass and Mortgage Achievers. And today's training, we are going to talk about what is mortgage insurance, or what we're all thinking of is, why is everyone putting their hand in my back pocket? All right, this is Larry with Mortgage Achievers. You can see my information at the bottom, 303-944-2277 if you have any questions, and you can go to lenderlarry.com. So anyway, let's talk about this. What is mortgage insurance? So before we talk about mortgage insurance, let's just recap a little bit about what a house payment consists of. Now, again, your basic house payment is going to include your PITI, IMI, HOA, ABCDEFG. So the basic house payment, PI, principal and interest. So when you make your house payment, this goes to the bank, and the principal reduces the loan balance, and interest is the profit that the bank gives on loaning you that money for that 30 days period of time. Taxes, that's property taxes. So that's where it goes to the county. Insurance, now this particular insurance is your hazard insurance or your homeowner's insurance, not to be confused with your homeowners association fees. No, this is your hazard insurance, such as State Farm, Geico, Allstate. And then you have mortgage insurance, which is the topic of the discussion today. And that is when you put down 20% or less, you're going to usually have mortgage insurance. It goes by different names. PMI, private mortgage insurance. MIP, mortgage insurance premium, that's the FHA term. PMI is the conventional term. VA does not have mortgage insurance, but VA does have what they call a funding fee. Different topic. And then, of course, you've got your HOA, your homeowners association, if you live in a PUD, planned unit development. I live in the Highlands Ranch, Colorado area, and we pay, $142 for every 3 months, but we get a lot of things with it. So that is the HOA on the basic house payment. So again, PITI, principal and interest, taxes, property taxes, insurance, hazard insurance, then you've got mortgage insurance and possibly HOA. So that is a quick recap of the house payment. Okay, great, Larry. So give me an example. All right, so get your pencil and paper out. So we're going to use an example of a purchase of a home. And let's just say it's $250,000. A person is going to get an FHA loan, and we'll just use 4%. It's lower right now, but we'll use 4%. And an FHA loan is 3.5% of the sales price as the down payment. We'll use $150 a month for your property taxes, $125 a month for your hazard insurance, and the mortgage insurance is $170.89, and we'll use $50 a month for the HOA. So as you can see on my slide, I have all of that information down. So if you add this all up, you're going to add the PI, the T, taxes, the I for hazard insurance, and the MIP or mortgage insurance premium, and that comes to the $1,617.81. Now that $50 HOA fee is paid directly to the HOA, and it does not come or reflect in your mortgage statement. So that's an example of a breakdown of a $250,000 FHA loan house. So you're asking the question, why mortgage insurance? Folks, it's because statistically, if you have less than 20% equity in the property and something happens to you as a homeowner, whether your fault or not, and you can't make your payments, the home will eventually go into foreclosure. But if you had 20% equity, you can always call your local favorite realtor, by the way, I am one, and we can sell the house, and let's just say your real estate commissions are 5 to 6%. Couple percent for selling the house for title insurance and all of this, pay some back interest. Anyway, you'll still be under probably 10%, and you'll walk away with 10% equity of the house. So you'll only really lose about 10% of your equity if something happens unforeseen. So as you can see my chart, the greatest chance of foreclosure is within that 20% of where there is no equity. So that is why mortgage insurance comes in, because the banks say, hey, unless a borrower wants to pay 20%, we don't want to give them the loan because that's too risky for us. And so then you have the government that stepped in, through FHA, and or you have private entities such as MGIC, Radian, and a few others that are mortgage insurance companies, and they say, all right, we will loan the borrower, probably 5 to 15% of that money, and we'll just charge a higher interest rate and make it a win-win for all of us. So that is that's what is happening in the market. So then you, as the homeowner who does not have the 20% down, because why? Because everything else is so stinking expensive in life, and wages stink, but you still want to get a house. So that's why mortgage insurance. Now, quit yawning. There are different types of mortgage insurance. And so if you're going through this presentation, it's because you actually want to know this stuff. So you got different terms and the same old stuff. Again, earlier I said PMI is private mortgage insurance. And that's for conventional loans. And they have these factors. You can see 0.32 to 1.1%. Depends on your credit and the loan to value of the house. So if you put down 15%, then your mortgage insurance factor would only be 0.32. So let's make the numbers easy. Say your house is $100,000. We both know you can't get that, at least in the Denver area. You're not even going to get a condo for that, but let's just use the money easy. So 0.32% of $100,000 is what? Well, let me get my calculator. And 0.32%. So it's going to be, $26 a month. So it's $320 a year, $26 a month. And again, if you go to the higher one, the 1.10, you're like looking at $1,100, or maybe around, 90 bucks a month, a little bit less than that. So that's PMI, private mortgage insurance. So that's for conventional loans. FHA, MIP, mortgage insurance premiums, same thing, just the factors the same. And the one thing about FHA, it's a 3.5% down loan. So if you came up to me and said, hey Larry, I want you to help me get a loan. I want an FHA loan and I have 50% to put down. No chance of it ever going into foreclosure because I can always sell it. Remember, Larry, you said from the slide before, you only need 20, but FHA is a little different animal. Thank you, government. They will require mortgage insurance no matter how much down payment you put down or what the loan to value is. And their factor is 0.885% if you put 3.5% down. If you have, I think under 0.9, it's just 0.8%, but not much less. But hang on, folks. FHA has a second mortgage insurance, and it's called the Upfront Mortgage Insurance Premium, UFMIP. And what they do there on all the loans, they say we're going to add 1.75% of the loan amount on top of your loan. So if you had a $100,000 loan, that's $1,750 will be added onto your loan. So that is a little bit how mortgage insurance works in our world today. So a little bit more detail for the PMI, private mortgage insurance. As I said, it applies to conventional loans. And if you put down less than 20%, it will be required. And so here's an example on this slide. You can see it. Sales price $250, 5% down, 700 middle credit score. And so in this case, the factor is 0.94. So a $250,000 house, you times it by the 5%, that's $12,500, or you minus your 5%, and your new loan amount is $237,500. So you take your loan amount, $237,500, times it by 0.94%, that's $2,232.50 a year. Divide by 12, $186.04. So the FHA loans, as I mentioned earlier, there are two mortgage insurance on the same loan. The first one, the MIP, which is 0.8 to 0.85%, and then that upfront MIP, which is the 1.75 added to your loan, and I will give an example next. Okay, so here's the FHA example. Everything's the same. Again, usually 3.5% down. The monthly factor 0.85. So we got our $250 sales price, 3.5% down, 640 middle score. So that's one nice thing about FHA is you can have lower credit scores and still qualify much for an FHA loan, where conventional, you're starting to get iffy on these lower credit scores. So the 250 minus 3.5% is 8750. Your base loan is 241,250. So we times that by 0.85. That's 2,050 a year, or 170 bucks a month on it on top of that. Then next we will have to add the monthly, or the upfront mortgage insurance, which is our next slide. And understand this 0.85 insurance, even if your house appreciates in value and it's worth 20% or 30 or 40 or 50% of what your loan is, that of what it's worth, you still can't get rid of it unless you refinance it to a different type of loan, namely usually a conventional. So the second part of the FHA insurance, mortgage insurance, is again that up front. So we just take that 1.75, add it to that base loan of 241,250 that we had earlier, which is 4221. So then our new total loan for FHA is 245,471, and that's how you add the upfront mortgage insurance on the FHA loan. So in summary, if you put down less than 20% of the sales price, or have less than 20% of the equity in the home when you're refinancing, usually you're going to go, you'll be paying mortgage insurance. Now, again, if you have an FHA loan, you could have a 50% equity and it still will have mortgage insurance. But in that case, we normally steer you to a conventional loan. And if you have a conventional loan and later the equity does increase above the 20%, you may be able to get rid of it. Usually you're going to have to pay for an appraisal, roughly about $500, and the mortgage insurance company will still require you to submit an application. And some of them want you to keep their mortgage insurance premium for several months before they'll let you out of it. Again, if you have FHA, you're stuck. So that's the summary on the mortgage insurance premium. So if you have any questions and you want maybe a further explanation, feel free to contact me. It's my lovely wife, Cindy, there. Larry Bass, the owner of Mortgage Achievers Corporation, 303-944-2277. And you can reach me at Larry@lenderlarry.com, and I'm in the Colorado area. And if you happen to get this on YouTube and you live in another state, feel free to give me a call, say hi, and I'll still explain it to you. I'd love to help you in any way I can. So until then, you have a great day, and I'll talk to you later.